Hello, my name's Charles Lastic. I'm the Managing Director of Blue Bond Tax Planning. We've been inheritance tax specialists for more than 18 years and have helped hundreds of clients save millions of pounds on their inheritance tax. So today's video is around the basics of tax within a limited company, with particular reference to people trying to decide should they hold money in a company or properties in a company compared to owning them personally. Hi and welcome back, and today's video is around taxation on limited companies and why you may want to own assets in a limited company, but how it works with regards to the tax, whether you own it personally or whether you own assets within a limited company. This is especially true for landlords, for example, who want to own property within a family investment company. So in many ways, taxation on companies in the UK may be even simpler than personal tax. So with personal tax, you have a range of allowances. So the first earnings or taxable income up to 12,750. So at the time of talking, I'm talking about 2023 tax year. So the first 1270 is exempt from tax. Really, but don't focus on the rates. It's more about what this is about. Then you get a basic rate of tax of about 20%, and that at the moment runs from £12,751 to 37,700, and then anything above 50,450. So that's taking into account, from the 37,700 up to 150,000. Effectively the tax rate is 40%. Then you pay an additional tax rate of 45% for the amount over 150. So there's this whole range of bands. You can look it up online any given time as to what the bands are and how it affects you. Now, on top of that, there is capital gains tax, where are different rates and different allowances for whether you're selling assets or whether you're selling property. So again, that would be need to look at. So it's a wide range of different taxes. So on a company, however, you don't pay tax on the income into the company, but purely on the profit. So whatever the profit is, it's taxed at the chargeable rate for that company. So again, don't focus on the rate so much as to how it works in principle, but from 2023, the main rate of corporation tax will be 25% for companies with profits of 250,000 or more. Now, interestingly, this applies to all profits, including that below 250. So there's no marginal rate. The moment you go over 250, you're going to be paying 25% corporation tax. However, if you're making less than that, there'll be a small company's allowance, and you're paying 19% with profits up to 50%, and then the rate will vary between 19 and 25% from between the 50,000 up to the 250,000. So again, different rates, but it's simpler in so much as there is no capital gains tax. It's just tax on the profits. So if you sell an asset, it's liable to the tax on the profits, and there's no separate capital gains tax within companies. Okay, so to understand that marginal rate, again, I put a little graph up here just showing you. So 0 to 50%, you pay 19%, 50 to 249,000, it's an effective marginal rate of 26.5, and then anything over 250, you're paying 25% tax. So those are the rates, very simple, no capital gains tax, as I say, applied, just the profit on the company. But now the money's in the company, and then you have to extract it. So there will then be a personal income tax liability as you extract the money, because you're going to have to take the money out in some way. So how do you take it out? So you can take it out as a salary, or you could take it out as a bonus. Now you would pay national insurance, so again you have to watch that. So most company directors tend to pay themselves up to £820 a month at the current regime, which is basically allows you to get salary on that amount, but it's within your £12,500, whatever the figure is of your lower band is, you know, but as I say, look it up, it varies. So whatever your band is, that money basically comes in, and you don't pay any national insurance on that money, but interestingly you still get a stamp for the state pension. That's why most people pay themselves £820 or thereabouts. Talk to your accountant about that. Okay, so how do you take the money out? Salary, you could take bonuses. Of course, on bonuses, again, if you go over your personal allowance, 12,750, I believe the figure is. Yeah, as I say, 12,750, then you will then pay income tax at whatever your rate is above that. So usually dividends are a better way of taking the money. But if you compare it to paying it personally, if you're a basic rate taxpayer and you're only paying effectively 20% up to the higher rate band, then that's better than paying 19%, even if your company isn't making a lot of money, plus 8.75 dividends. So inevitably, taking the money out of a company is more expensive in terms of income tax. And with capital gains tax now, because recently in November 2022, Jeremy Hunt slashed what your allowances are for capital gains tax. Again, you would need to look up those exact figures, but now even then that advantage has gone personally. So in many ways, companies, because of their benefits of protecting your assets in the long term, in other words, you're not personally liable, especially if you own properties, it may be worthwhile considering. But again, if you own properties, there are the issues that mortgage rates might be more expensive. However, if you've got a big property portfolio, you're almost certainly better off having it within a company, because don't forget, you can pay money into things like pensions for yourself, pensions for your children, that kind of thing, which is directly offsetting the profits of the company. So end result, if you're looking to take most of the income out of your company, you may not be better off in a company as far as income tax is concerned. If, however, a lot of the income just rolls up because you don't need it, then you're almost certainly better off having it in a company. But then when you consider the IHT rules and you're able to give your shares of your company away directly or into an employee benefit trust, there are the benefits of a company within inheritance tax as well. So it's not simple, it's not straightforward. We discuss all of these different variations with clients in their meetings when we're trying to determine exactly how you should hold your assets. And of course, when we do annual reviews, we review this on an ongoing basis as well. But very simply, if you're going to take all the money out of the company for income tax purposes, you're better off holding it personally, and effectively for inheritance tax, you're probably better off having it in a company. If you're going to leave the majority of the income that's coming into the property portfolio, or the company owes you money through director's loan or redeemable preference shares, it's almost certainly better off in a company. Hope that helps. Understand it's a confusing subject for those of you who are new to limited companies, but talk it over with us and we'll explain it to you in detail in one-to-one meetings. Thanks and goodbye for now. Bye.